Welcome to This Explainer. Today, we are diving straight into how institutional algorithms leave massive, highly visible footprints right on your trading charts. I mean, if you've ever stared at a price chart and felt like the market just teleported from one level to another, completely leaving you in the dust, well, you're definitely not alone. We're going to decode exactly what that means and, more importantly, how you can actually use it to your advantage.
So let's start with a really crucial question. Have you ever wondered how smart money actually moves the markets? Because today, we're pulling back the curtain to see how the big banks and hedge funds displace price action. It's a super aggressive maneuver, and it's exactly what leaves regular retail traders either entirely stopped out or, desperately chasing the trend way too late. And that brings us to our core concept for the day, the fair value gap, or FVG. Think of a fair value gap as a missing puzzle piece in the market's natural price delivery. It's an area of pure, sheer imbalance. Basically, it happens when the market moves so incredibly fast in one direction that buyers and sellers just don't get a chance to exchange at a fair, balanced price. It creates this vacuum, literally an empty gap in the trading activity.
Okay, here's our quick roadmap for this explainer. We're going to hit the smart money footprint, the anatomy of the gap, bullish and bearish setups, executing the strategy, what happens when gaps fail, and finally, we'll wrap up with a massive FVG data twist that you absolutely need to see.
All right, Section 1, the smart money footprint. Let's look at exactly what creates this unique void in the market.
The best way to visualize it is to imagine the market taking the stairs 3 at a time. Under normal conditions, price action steps up or down just one level at a time, finding buyers and sellers at every single tick. But when large algorithmic players, the real smart money, enter massive block orders, the price moves so aggressively that it completely skips certain levels. It just vaults right over them. This creates an undeniable inefficiency where retail traders couldn't even react if they tried.
Moving on to Section 2, anatomy of the gap. Let's break down how to actually spot this footprint on your screens.
So the visual mechanics break down into a really strict 3-candle sequence. This is your anatomical blueprint for an FVG. First, candle 1 establishes the starting range. Then candle 2 is your displacement. That's the massive institutional push, usually with a huge body. Finally, candle 3 comes in and confirms the gap. Now, the absolutely critical detail here is that the wicks of the first and third candles never touch. That empty space left between those two wicks, right there, that is your fair value gap. Now, looking at this on a real 15-minute chart, it becomes super obvious. See that empty space sitting right in the middle candle? That's where trading activity simply vanished. The high of the first red candle and the low of the third red candle don't even come close to overlapping. The smart money dumped so much volume into the market so fast that it created a literal void. Let's jump into Section 3, bullish and bearish setups. These gaps actually act as a fantastic compass for market direction.
The crucial takeaway here is that a bullish gap signals explosive upward demand from buyers, while a bearish gap shows sellers violently driving the price down. In a bullish setup, the gap forms between the high of candle 1 and the low of candle 3 as the price just rockets upward. Conversely, the bearish FVG leaves a gap between the low of candle 1 and the high of candle 3 as the price plummets. Recognizing which one you're looking at instantly gives you the institutional bias for that specific moment.
Okay, Section 4, executing the trade strategy. We can spot them, we know their bias. Now let's talk about exactly how to capitalize on this and execute a trade. Honestly, patience is the name of the game here. Do not chase that big displacement candle. Instead, you want to wait for the price to pull back or retrace into this imbalance zone. Once price is inside the gap, you're looking for a rejection or maybe a hold at the exact midpoint of the gap, which is a level known as consequent encroachment. You then enter in the direction of the original trend, keeping your stop loss safely tucked just outside the opposite edge of the gap. Oh, and if the gap is breached entirely, the setup is invalid. Walk away. Now, this quote really hits the nail on the head when it comes to the core inner circle trader, or ICT, philosophy. The idea is simple: the market absolutely abhors a vacuum. It algorithmically seeks to rebalance these skipped levels before continuing the trend. So, think of the FVG as a magnetic zone of unfinished business, right? The market left some orders behind, and it kind of needs to come back and pick them up before it makes its next major move.
Which brings us to Section 5, when gaps fail. Because we really have to ask the hard questions. What happens when the smart money just blows right past our carefully marked gap?
Well, when that happens, instead of a complete loss, it actually creates an inverse fair value gap, or an IFVG. Basically, the gap flips its function. It acts exactly like a powerful support-turn-resistance flip. So let's say a bullish gap, which was supposed to be a nice bouncy support floor, gets completely smashed through to the downside. It immediately transforms into a new ceiling, or resistance zone. This actually hands you a brand new, highly profitable entry opportunity going in the opposite direction. You're literally just pivoting with the smart money.
All right, Section 6, the FVG data twist. Prepare yourself, because it's time to completely shatter the biggest myths surrounding this strategy using some cold, hard data.
So, the traditional smart money narrative tells us that price must return to completely fill these gaps to rebalance the market. You will hear traders say all the time that an FVG is a guaranteed target. But let's actually look at what market data from the Edgeful blog tells us about thousands of these gaps tracked on YM futures. Does the market always come back to fill the void? Well, no. In reality, a shocking 60.71% of bullish fair value gaps actually remain completely unfilled during their intraday session. Yeah, you heard that right. More than half the time, the market never makes it all the way back to close the gap before the day is out. And looking at the broader picture, both bullish and bearish gaps fail to completely fill most of the time. Get this, bearish gaps remain unfilled over 63% of the time. This proves they are far from the absolute, guaranteed magnets that so many trading gurus claim them to be. The smart money might leave a footprint for sure, but they aren't always in a rush to come back and sweep it away. Therefore, your major actionable takeaway for your own charts is to treat these zones as firm support or resistance boundaries rather than betting your entire account that the gap will fully close. You can totally look for entries when the price grazes the edge of the gap or hits that 50% midpoint we talked about. Just don't use the full fill of the gap as your primary take-profit target because, statistically speaking, it's just not going to happen most of the time.
So, I'm going to leave you with this provocative thought to ponder the next time you boot up your trading platform. If algorithms purposely leave these footprints unfilled over 60% of the time, are you actually trading alongside the real smart money? Or are you just chasing ghosts? It's a vital question for anyone looking to master market structure. Thanks so much for joining this explainer. I really hope it brought some serious clarity to your charts. And remember, always follow the data.